Hello and welcome to Business Today Television. I'm Siddharth Zarabi, and with me now is R. Shankar Raman, the whole-time director and CFO of L&T. Welcome to the show, Mr. Raman.
Thank you.
Let me begin by asking you to comment about what really drove this strong operational and financial performance in the quarter. Pretty much an all-round show where you've delivered on most counts.
A lot of hard work, Siddharth, and commitment to deliver because I think we find ourselves in a space where the investment momentum, both in India and in Middle East, the two large markets that we operate in, has been pretty encouraging. And given the fact that these investment momentums are not linear cycles, they peak and trough, it was important for us to be able to stay competitive and take advantage of this tailwind that's behind us, which I think I'm happy to report that we've been able to do that well. The fact that Middle East and particularly Saudi Arabia is investing heavily in spaces like renewable energy. In fact, they're financing the investment in energy transition through investments in hydrocarbon. And given the fact that the prices of hydrocarbon is where it is, I think it also makes the business case that much more stronger. So all the oil fields and the gas fields that are there are getting exploited, and the revenue that is getting generated is used for investing in in solar, as well as in downstream industries. I think there has been a realization there that if they build industry around the energy intensive areas of operation, for example, it could be fertilizer, it could be refineries, the value add that they could get out of the dollar invested could be that much higher. So that actually plays to our strength, because these are areas we have been operating in India for very many years. Our skill sets are right up their requirements. So consequently, I think the Middle East investment momentum has helped us. The order sizes of Middle East is typically large, much larger, 3 times, 4 times the size of Indian orders. So to that extent, I think if I set aside the lumpiness of these order inflow, the ability to scale up the order inflow has been substantially helped by Middle East orders. India has also grown, but grown at its own pace and at its own size. Domestic orders have grown by about 15% for the half year, which is not bad, but pales in comparison to the Middle East orders. But the fact that India is also investing in areas which to our strengths, and also the fact that India has chosen the path of investment-led growth, has helped the company to take advantage. I think the most important aspect of this all-round growth is ability to mobilize resources and be in a position to execute. Because winning orders is one part of the story, executing it well is the most important part that follows. So the company, given its track record and ability, brand, etc., is able to possibly be at the forefront whenever these investment cycle turns as favorable as they have been.
You've given me several points to follow up on, and while the markets have digested the numbers very clearly, one of the interesting points in your comment just now is the Middle East. And the question that is now being asked is, will the Middle East continue to be a strong market for a company like yours, given the current uncertainty that has developed? And also, are we to assume that the large hydrocarbon order that you have just announced is also from Saudi Arabia?
Yep. Actually, Saudi Arabia is a very important stakeholder in our order book. Almost 35% of our order book is international. And when talk about order book, it's about $55 billion, about 450,000 crores. 35% of that is international orders, and 30% of that order book is Middle East. So almost 85% of the international orders that we execute today are in the kingdom. Now, this has its own advantages and its own challenges. Saudi Arabia, given its own Vision 2030, is positioning itself to be a broad-based market, a market where international tourists will come in for multiple reasons. So the need to develop infrastructure and the associated facilities. There's a very strong momentum to positioning Saudi Arabia as a desirable destination, both for capital to flow and people to visit. For a start, Saudi Arabia has enormous wealth. To that extent, the seed funding of their initial plans, be it the rail network or be it the large hydrocarbon investments that they're doing, and a very large solar investments that they're doing. World's largest solar plant is in Saudi Arabia, and we are happy to be part of it. So the investment is very broad based, and what Saudi is trying to, I think, achieve is amount of neutrality in this conflicted zone. That's why you find in the most recent escalation in Israel, Saudi's presence has been extremely low key and very, very tactical. There's no direct participation in what is happening there. And Saudi is also committed to developing its own supply chain. So there are requirements on contractors like us to maximize what we could procure and use out of Saudi resources. So in a way, it is a bit of a localized developmental opportunity within the country. And fortunately for us, none of our supply chain, which cater to that requirement outside of Saudi market, is positioned in any of the strife-prone regions. So to that extent, I think we are insulated from the war insofar as our progress is concerned. Is it becoming a large market to worry about? I think we are looking at it as glass half full. It's a large opportunity, and we need to figure out a way to expand our capability to meet that opportunity. One approach could be to say it is too large for us to handle and back off. The other way is to say how to build our capability and scale up our competencies to be able to take advantage. Saudi is not a new market for us. Almost close to 20 years we have been working in Saudi. Saudi took their own time to decide on the level of participation by L&T. We started off with contracts as small as $200 million, $250 million, etc. They made sure that we were delivering consistently, and over time, these $250 million became $500 million, became $1 billion, and the last reported order is $3 billion. So I think the important part of this is execution track record, our own obsession that we deliver to the requirements, which are normally top class. They follow European standards when it comes to execution. So we had to really crank up our execution machinery to be able to do that. We had to move our senior management in charge of execution to the local market there. Initially, it was tough to convince people to move to Saudi Arabia. But as things opened up and Saudi became a little more liberal in its outlook and social structure, it became increasingly easier to get our people to move there and work on the ground there. Today, close to $16 billion worth of order backlog we have in Saudi Arabia. So the engagement level of our people is very high because it's not that they go there for a project and come back scampering home. They are there for longer term. So they're able to stabilize their social and personal requirements. At the same time, take advantage of the opportunity. The other advantage Saudi provides is the partnerships, the global partnerships. I think our ability to expand our competency, thanks to the association with peer sets, which are far more evolved in working in those markets, has also helped us deliver better. And since these skills are fungible, the work processes that we follow there, we are able to bring it back to India and make Indian projects that much more efficient to execute.
I want to turn our attention to the domestic market, but before I do that, just one more quick point to follow up. There are other economies in the Gulf region which are been considering shifting away from their, almost universal dependence on hydrocarbons to new energy and other forms of revenue. Is your business also riding along in the opportunity in the rest of that particular market. And I must emphasize for our viewers that the contrast with the rest of the developed world and the kind of growth that the Gulf or some other economies are delivering is a big contrast. And I'm sure you would agree with me on that point as well.
Very true. I think the size of investments matches their ambition and vision that they have developed. I think we have been active in markets like Qatar. You might have possibly noticed that the FIFA World Cup was played in one of the stadiums that we built, and the associated sports facilities were used. We built the Doha Metro, which people use to commute today. So our association with outside of Saudi has also been broad-based and not confined to only hydrocarbons. I think we do believe that Abu Dhabi, we have built many years ago an airport terminal in Abu Dhabi. We have built a resort. We have now built a desalination plant. We have done fair bit of substation and transmission line work in those markets. So Abu Dhabi, Kuwait, Oman, and Qatar have been supplementary partners to Saudi. But the Saudi size dwarfs the investment that the others make.
Absolutely, and that's very evident. Let's turn our attention to the domestic market. And for the last few years, Mr. Raman, the government of India, as well as many states, have been investing quite a bit on infrastructure. And you could say that infrastructure is the one story that is consistently performing. And you have a very large order book within the country as well. Take our viewers through your own reading of how this infrastructure-led development is panning out, and what sort of a bigger role do you expect L&T to play?
I think if I look at it from a pure economics point of view, I think the government was right in spotting areas which would provide them tax revenues. The country required developmental spending, and the country did not have a credit rating which will enable dollars to flow ceaselessly. So it was important for India to develop its own resource base. And I think the government focused on two things. One is to bring out reforms in the area of taxation and make compliance a bit of an optionless situation for people by enforcing the compliance. So I think that has played out well, and today the government is close to collecting 24 lakhs of crores of both direct tax and indirect tax. In a budget of 45 lakh crore, 25 lakh crore is a big chunk of resources that the government is beginning to command. So it's a win situation as far as the government is concerned. What makes it win-win is to spend that allocation wisely to create further economic pools that could drive both growth, employment, as well as tax revenues. So this entire push towards Atmanirbhar, etc., even though that got accelerated by the global pandemic, supply chain disruption, and let's say the geopolitical developments versus some of the long-standing trading partners of the country, pushed the government to do this. But the long-standing benefit is growth through investment seemed to be a good model to follow. And the last 4 or 5 years have demonstrated that it's a game which, if run well, can be beneficial to all the stakeholders. Today, the growth is far more inclusive. More villages are lit up than ever. More water connections are available. Sewage treatment plants are dotting the landscape. We are talking about dedicated freight corridor. We are talking about road connectivity, port connectivity, and we are talking about urbanization development, which would include the metros and all the associated developments in the urban area. So in a manner of speaking, I think India latched on to a model where if you could find the resources to invest, and if you could find partners to execute, then the country's growth can get stronger. And that's demonstrated by the growth. I mean, in today's world, an economy as large as us, returning a GDP growth of 6.5%, 7% is something that we can be justifiably proud that we've sort of got onto the right path. What is most critical now is the continuity of the policy. I mean, once in 5 years, being a democracy, I think we will go through this churn of the political equation shifts and the consequences thereof. But if we can, as a country, as a society, as an economy, think about how we deal with meeting the aspiration of so many people, 1.4 billion people, and growing. And already we are most populous. So there are going to be more graduates coming out, more mouths to feed. And hence, I think the landscape for development is absolutely fertile. We need to know what levers to pull and how to operate them. My own sense is that the evolution, the stage of infrastructure development in India is at a stage where on a scale of, let's say, 10, we could be pushing around 4. There is so much yet to be done. There's so much connectivity to be done. There's so much of solutions, infrastructure solutions that need to be provided. We have taken big leaps in the area of digital infrastructure. Physical infrastructure has lagged behind, digital infrastructure has leapfrogged. We also need to keep pace with physical infrastructure because the digital infrastructure cannot provide physical solutions. So my guess is this catch-up game is a good, healthy competition between the digital and the physical. And L&T, fortunately, is well placed between both these spaces. So I do think that as a country and as a company, consequently, we are looking at long-term growth prospects with a lot of optimism. We also need to make sure that while we leverage on these existing opportunities, we also create new streams of business, revenue, growth, and profits. This is the right time for us to seed investments, which can take the company forward 20, 30 years ahead of time. So we are parallelly trying to work on strategies and areas which could also secure the future for the subsequent generations.
Right. Is that therefore the reason for the semiconductor design foray? And is that ambition just limited to design, or is it likely to transcend into actually setting up a proper fab as well?
At the moment, we are fabless in our plans. We're not going to be setting up a fab unit, etc. We think that given the engineering background that we have, designing a chip is a little more up our alley, if I can say that, even though it's a new area. We do have our listed subsidiary L&T Technology Services working on some solutions for customers. But these are solutions based on design provided by the customer. So we thought of getting ahead on the value chain and start co-creating along with the customer the tomorrow's chips in terms of what functionalities they could pack to deliver. Now, by doing that, we are able to take advantage of our global network of clientele and connect that both our engineering business as well as our IT business has provided us. And secondly, to take advantage of the large talent pool that India has when it comes to these design engineers. L&T being a brand name associated with engineering, we do think that given the right structure and the right business model, we should be able to attract talent. So the vision at the moment would be to be operating at the higher end of the value chain and contract out the manufacturing, testing, packaging, etc. To players who can manage scale. We do not at the moment think that the competitive advantage that we can bring to table would be sufficient to justify the investments in the manufacturing place. Having said that, we've also wanted to participate in the energy transition space. This again is arising out of our own conviction that unless we do something as an industry, this climate change is going to actually erode the viability of several businesses and also the basic social structure. Increasingly, the carbon emissions are creating troubles. Even our current generation is actually facing the consequences of this. So we think as a responsible corporate industrial house, we need to do something on this transition. So we again evaluated the whole landscape and we felt that solar among the renewable energy as well as hydrogen among the alternate fuel are the two areas that we would like to possibly explore what we could do to contribute. And solar we have done very well. And I think We are the largest solar EPC contractors in India. We don't generate solar power, but we help people who want to generate solar power by putting up the infrastructure. And we have now expanded to Middle East. As we speak, almost $5.5 billion worth of orders in Middle East. We are executing on solar. Middle East is a very natural place, like Rajasthan and parts of Gujarat. Land in abundance and lot of sunshine. So I think solar will be a major part of the energy transition in Middle East for the world, and we are participating. We are in the thick of it. As far as hydrogen is concerned, we obviously wanted to not be a manufacturer of hydrogen at the first place. We wanted to set up manufacturing facilities for people who want to get to hydrogen. Thanks to the government push, all the public sector refineries led by IOCL are looking at generating hydrogen so that their carbon emissions can be controlled. And they would require an EPC partner to work with. We have thrown our hat in the ring, and we think we will get advantage of this partnership early on. And hopefully that will take us to hydrogen manufacturing, EPC contracting, wherever in the world that this comes up. Of course, our solutions will have to be efficient and competitive, and the first of the orders that we get will help us do that. We also thought of a product, which is the electrolyzer. We have tied up with McPhee Energies of France. We have now, as we speak, putting together the first electrolyzer, which will be out as a prototype by the end of this fiscal. And depending on how successful we are in the features and the cost competitiveness, we should be able to roll this out as a commercial product in 24-25. And this is a global product if we are able to get our act together right. And we do believe that both the EPC as well as electrolyzer manufacturing in the place of hydrogen, solar in the place of renewable energy, are things where we would like to contribute.
I want to follow up the point about semiconductor with the point to our viewers that amongst the very few, in fact, you can perhaps say just 2 or 3 companies who have the ability, the scale, the financial depth, and more importantly, a long-term 20 to 30-year vision and execution capabilities, L&T. And therefore, Mr. Raman, to me, it would seem, and I'm not trying to advise you, that it would be logical for someone of your size and ability to go the whole hog in semiconductors, given the size of the market opportunity that it will eventually present if we get the manufacturing and the technology part. The government has a PLI scheme. We have seen several companies throw their hat into it. I'm just wondering, is it the lack of government incentives, or do you think the market is not big enough to draw your attention to not have the ambition to go the whole hog?
Fundamentally, our belief is that no business model should be premised on concessions and tax benefits. I think it would be a fallacy to base the business model on these streams, which can dry up. A stroke of a pen can take the policy away. So that's something that we stayed out of. If concessions are available incidentally and they're going to be icing on the cake, so be it. But the fundamental assessment has to be done on the basis of economics stripped of these benefits. Secondly, when we look at this semiconductor, and today Indian market is about $25-27 billion, and it is expected to grow to about possibly $50 billion by 2030. It's going to be an evolving space. It's like pretty much like hydrogen. We have very advanced players and participants who can just muzzle you out of market. So we need to be conscious of the fact whom we will be competing with. Do we have the capability as we start today to compete with those biggies? The answer is no. We need to create a niche for ourselves. And the niche can be created if we start partnering for generation of tomorrow's piece. As the world is focusing more and more on nano chips and packing more and more, stacking more and more, and the gadgets are getting the primary focus, we want to stay with the industrial end, which helps us to work on, let's say, 40 nanometers and thereabout sized chips. And also, these chips are what they call as mature nodes. So when the attention of the global majors are on finer and more sophisticated chips, we wanted to take advantage of the space that is getting vacated in the industrial area. And secondly, we ourselves as an industrial house are realizing the advantages that we get on productivity by automating our equipments, by putting sensors on our equipments, by gathering data which were just left to elements earlier. We never saw it as an advantage to have this data with us. Today, over 30,000 pieces of equipments that we employ through our 1,000 odd sites, at least 10, 12,000 of the equipments are interconnected. So today we have data spewing in from all these places, and the challenge today is how to interpret this data to our advantage. So we think that digitalization and the chip being embedded on industrial equipments is a large market, and that is close proximity to our own engineering and manufacturing strength. So we have sort of chosen that area. We'll have to wait and see as to whether this will provide the scale for us to put up manufacturing. Manufacturing, I agree that we have both the longevity and the duration to be able to do it, apart from the balance sheet strength. But at the same time, we have to be responsible for value creation to our shareholders. If we cannot manufacture profitably, if we cannot compete with the Koreans, we cannot compete with the Chinese in a global market, we need to think through very carefully as to what is it that is going to mark us out as a unique selling proposition. Is it going to be features? It's going to be cost competitiveness. Secondly, the cost of the chip is very low as compared to the cost of the ultimate product. How much value premium will that chip get? For example, a $10 chip on a $300,000 product, how much can you squeeze into a $10 chip? So end of the day, chip is an enabler, and it should have its own space in the cost economics of a product manufacturer. We need to size that up as well before we set it up. We are late in the game from a global context because there are manufacturers who are in this space for 20 years plus now. So we need to recognize the fact that we are time disadvantaged. So we need to work with products of tomorrow. And to start with, design could be a good place to secure our footing.
I'm glad you gave us that answer, and I also want to add that this is, viewers, the reason of what we in the journalistic and analyst community call the L&T way of doing things, and that is why L&T is the company, the giant that it is. Mr. Raman, as we wind down this conversation, I want to turn to more immediate pressing concerns for our stock market viewers, and which is to talk about the numbers for the remaining 2 quarters, especially your margin guidance and how the overall outlook for profitability looks like in the remaining part of the financial year.
We are on an improvement trajectory. I had mentioned this earlier, but it's worth repeating that much of the projects that we are executing now are those that were committed around the pre-COVID time. And the cost of procuring the inputs for all of these projects that we are executing happened post-COVID, where the supply chain disruption happened and so many other things that happened. So consequently, the first task for us is to complete these projects so that we can go back to the client and say that despite these hardships, we have delivered what we commissioned us for. Thereafter, there will be an inevitable conversation around the cost overrun, the time extensions, etc., and some compensations would come in, and those would flow in as additional margins in the future quarters. But at the moment, the quarterly numbers that you see and the softer margins that you see have been anticipated and even communicated that the first 2 quarters of the current year would be soft, and they have been so as we report these numbers. The only heartening factor here is as the quarters go by, the stock of orders of that legacy pool, if you can call that, is diminishing. And over the next 2-3 quarters, the shadow effect of the cost overruns that we have on those projects will begin to diminish, and the new jobs that we have obtained based on current costing will start playing up. Now, this transformation of the mix will enable the margins to improve. But since we take 3 to 4 years for projects to be executed, this improvement will not be one-step improvement or 1-quarter improvement. This will happen progressively quarter on quarter. Quarter 1, for example, of the current year, we reported an infrastructure margin of 5.1%. Quarter 2, we have printed 5.4%. And whole of last year, we reported 7% for infrastructure segment. Now, the distance that we need to travel is just as we took 5.1 to 5.4, 5.4 to somewhere else and somewhere else to somewhere else, we need to move towards a more normalized margin of, let's say, 7% on this segment. That automatically would mean on an aggregated basis, the margin of 8.5% that we printed last year, which is currently at half year level at 7.4%, now needs to get out of that 7.4% range, move into 8% range, and then move beyond that to 8.5% range, and then thereafter move to about 9% range. This would take possibly 2 quarters at the least to achieve, and maybe more like 3 quarters going forward. So I think what the markets I would request to track is whether we are on this improvement journey without any further hiccups. And so long as this journey gets completed well, I think 24-25, the company will be able to report more normalized margins, more in appropriate proportion to the kind of work that it does.
Mr. Raman, there is always so much to discuss with a company of your size and scale, but we are running out of time. But I'll still ask you for a quick comment because we have spoken about the government push. But your reading of the private sector investment uh, and the talk about where it stands today, your own sense is private sector capex coming back, and how's the outlook as far as you are concerned?
It will come back. In my opinion, it has already come back in pockets. It's not gathered a momentum which sort of matches the government spend on infrastructure. If you look at the automobile industry, it has invested. If you look at the paint industry, it has invested. If you look at the cement industry, it has invested. The steel industry, it has invested. Data centers has been invested. Commercial properties, private capex has gone in. Airports, the Bangalore airport, the Hyderabad airport, and the newly built Navi Mumbai airport, all of that are private capex. So today, the spike you saw in private capex, let's say between 2006-7 to 2014, was a lot of private-public partnership. The government leaned into the private balance sheets to be able to spike up the investment. And the banks and the other financial institutions also willingly participated in this whole spike. But what happened between 14 and 18 or 19 was many of these private investments were actually impaired by either because of the lack of progress they've been able to achieve on their plans, or for that matter, the environment change. I think building public assets with private capital has a limitation because private capital has a maturity date, and the public assets that it builds has much longer time frame to pay back. So the private balance sheet tried to substitute the pension funds and the insurance funds and the sovereign wealth funds in owning these assets, and quickly came to grief. And along with the private sector, the banks also came into grief. So we had this spate of NPAs and write-backs, resolutions and stuff like that. But fortunately, 3, 4, 5 years down the line, we find that the private balance sheets are far healthier today, cleaned up. Resolutions have been worked out. To that extent, the Insolvency and Bankruptcy Act has also helped the process. And today, the banks are also a little more credit hungry than what they were 5 years. So the conditions are ripe. Now, the private sector, having actually sort of rushed into an investment opportunity, has got a little more thoughtful today. The boards are asking more questions today. But wherever there is a compelling business case, I am not seeing the boards push back, or the investors or the promoters hold back the investment. But they're looking for a more sustainable economic outcome, which if the opportunity is able to provide, I think the investments are happening. Look at the investments that are happening in data centers, just for example, or look at the investments that's happening in hospital space, post-COVID particularly. And I think these are pointers to me that private capex is there, but the business case has to get compelling, and the ease of doing business has to improve. I think government has to now focus, in my opinion, to make compliance easy and to make the environment as seamlessly automatic as is possible. Today, we still have to make effort to get approvals, clearances, right of way, etc. These are not as automatic as the government wants it to be. The government actually wants it to be that way. But I think we have our bureaucracy to follow up, and all of the visible part of the decision making will have its own consequences. And the government bureaucracy believes that safety in numbers. If there are 10 people bidding for an opportunity, the price discovery is supposed to be more democratic and right. If there are two people bidding, then you're supposed to be pandering to a particular whim or a fancy. So unfortunately, that mindset needs to change. But I guess we'll get there, because if you're seeing the upsides of these investments, public investments particularly, and you can't leave the private sector out of it because their balance sheets are sizable, and you can't grow the country with only public balance sheet. And the private sector has to contribute taxes for public balance sheets to grow as well. So the health of the private sector is very important. Government will realize, has realized it in my opinion, but we'll have to enable it to happen. And I'm hopeful that between now and the next time we talk, we will have some more good news.
Absolutely. Viewers, I want to end by saying that when you have one of India's finest corporate minds, as someone who understands finance, and sitting in L&T, a giant through which you can see the entire economy. I started this conversation on the second quarter performance, but we have actually gotten Mr. Raman to talk about the state of the Indian economy as well as the global economy. And that was a pleasure. Thank you very much for your time with us today. Hope to see you again. With that, it's a wrap on this conversation. We'll be back with more. Until then, goodbye.
Hello and a very warm welcome to Business Today TV. I am Chetan Bhutani. Well, state-owned telecom infrastructure provider RailTel has come out with its Q2 numbers, and of course, a dividend announcement has also come from RailTel. And today, I am joined by the Chairman and Managing Director, Mr. Sanjay Kumar. Mr. Sanjay, thank you so much for joining us. First question, can you tell us about the numbers, sir? Really great set of numbers. 23% growth in profit, 68%, 68 crore rupees revenue growth, and 40% also. A great set of numbers coming in, sir. What are you attributing these numbers to?
See, this quarter we have performed with projects very well, and the margins, the projects which we were working on, were carrying healthy margins. So that's why these results are there before you, the way they are. We have performed well as compared to last quarter. And we are sure that project performance will continue to be there throughout the year.
Right, sir. And sir, if I look at EBITDA margins, sir, also about up 15 odd percent. Don't you think that EBITDA could have been a little higher on the upper side, sir? Because considering a rapid consumption has happened and rapid expansion plans have also taken place in this current quarter.
See, on one